and slowly moving into the world of differentiating between the required rate of return and expected rate of return. How do we use all these concepts as a part of the typical valuation process? So this is the typical process which we are going to follow. And more importantly, the reason why we look at the concept of return is it plays a very important role in the equity valuation process. How do I find out what is the return this particular security would be giving when I am investing in it today? Or based on the return, how do I assess how much should be invested to purchase the share of this particular company? All these things, they get driven internally. The equity valuation process is dependent heavily on the concept of return. So that's where we are trying to understand the various mechanisms which can be used to compute the returns and the various dimensions from which the return is typically defined. So with that as the base, let's get into it. So when we talk about the return, we use different definitions, starting with a holding period return. So let's say I have I have purchased a security long back at some P0, and today the price of it has become P1. I don't know how much time has passed between this and this. Some time back I have purchased the security at P0. Today the price of it is P1, but in the meanwhile this security has given me some kind of benefits, and let's say that benefit during this period is what is D1. So overall, at the end of this period, whatever is the period, at the end of this period, what is my return? I have got D1 during this period. Along with that, there is a change in price from P0 to P1. So the benefit which I have got is D1, and at the same time P1 minus P0. Express that in a percentage form. That is what I call as a holding period return. This holding period could be 1 month, 1 year, 10 years. We are not that much bothered about it. The day on which I have purchased the security, the day on which I have sold the security, whatever is the change in price, and whatever the benefit that that particular security has given during the holding period. So holding period is right from the time period of buying to selling, nothing to do with 1 month or 1 week or 1 year or 10 years. Whatever is the time period we are holding the security. So whatever the benefits that we have received during that period represented by D1, and whatever is the change in price during the period represented by P1 minus P0. That is the overall return, and I divide it as a percentage of my purchased price. I call that as the holding period return. But in this we need to understand that whatever the benefit that I am getting during the period, it is assumed that this particular benefit is coming towards the end of the year, means at the time of selling of itself. But if I am getting it somewhere in the middle, right, if the D1 is not coming here but it is coming here, this is the day on which I have purchased at P0, this is the day I am selling it at P1. The formula is assuming that D1 as a cash flow is coming on this day. But if D1 is a cash flow somewhere in between, it is said that try finding out a modified D1 as of this date by including the interest for this period. Find out the interest for that period on D1. So probably call it as D1 star, and then use it as a part of your return computation. That is what we call as the holding period return, where I am assuming that all cash flows are coming at the end of the holding period. If there is any change in the flow of the cash before the holding period, before the completion of the holding period, you can simply add the interest up to the holding period and update the intermediate cash flows and then use it to find out your holding period return. And in some cases, what we also see is whatever the holding period return that is typically coming out, people do annualize that holding period return. Let's say you have got your holding period is 1 month, right? Let's say your holding period is 1 month and you have got a 1% return during the month. Generally, when it is annualized, we say 1.01 to the power 12. We find the effective annual yield and probably say 12.68% is the holding period return for this particular investment. Though you have got 1% in the month, we are generally annualizing this holding period return and presenting it as 12.68%. Here, the only thing that needs to be careful is this 1% may be specific to this particular month. In the other months, I may not get more than 0.5% or probably I may lose 0.5%. All these things are possible, but whatever I got in a month, if I am converting it into a year by simply annualizing it, it may either over predict or under predict the return, right? So that's one thing an analyst has to be careful of when trying to annualize the holding period return, because holding period may be the period maintaining the consistency across all the periods for that kind of a return is a challenging thing. So that is one more aspect that needs to be comfortable with while understanding the returns. Then the next concept that I would like to look at here is the concept of realized as well as expected returns. Historically, whatever the return that the particular stock has generated or particular asset has generated is what we call as realized return. Historical, based on the past data, if I am able to compute that in the last 1 year this particular stock has given 15% return, that is what we call as a realized return. And the same thing when I am projecting for the next period, based on the securities expected performance and based on the understanding of the business of that particular company, if at all a return is predicted, if at all a return or a price is predicted for the next year, for the next period, we call that kind of a return as expected return. So it is purely based on the analyst's expectations. It is not a past data. Probably based on the past data and various other factors are based on the understanding of the company's performance. If an analyst is able to predict the future price as well as the return in the process, that is what that kind of a return is what we are calling as expected return. Then another important definition of a return that is coming in is the required rate of return. Required rate of return is purely looked at from the perspective of investor. Expected return is primarily looked at from the perspective of the security. Security's performance. Then that is what is resulting in an expected return. But when I say required rate of return, what is that minimum basic return which the investor is expecting if at all he has to invest in this particular security? That is purely based on the characteristics of the given asset, understanding the risk behavior of this asset. Based on the risk behavior of the asset, what is the return? So the dimension is different. This is not based on the risk behavior. This is based on how the company is going to perform in the next year from the operations dimension. This is purely from the operations dimension. What is the kind of return that I can expect from this particular security? But when I am looking at the required rate of return, I am trying to look at it from an investment dimension, primarily associating it with the risk of the particular security. What is corresponding to the risk which this company is having? What is the minimum return that can be expected if at all I have to invest in this particular security? So if the particular security is highly risky, the return expectation, the required rate of return would be much higher, and vice versa. Because the other way to define the required rate of return is it's actually an opportunity cost. I am foregoing some other opportunities to invest somewhere else by trying to invest in this particular security. So what is the minimum kind of a return that I have to expect out of this particular security is what is defining the required rate of return. Generally, for making investment decisions, people try to compare the required rate of return with the expected return. So based on the investors' expectations versus the actual operation performance of the company. If the company's performance is better, the expected return will be greater than the required rate of return, which means we can very well say, though the investor is looking for a return of RR, the company has generated a return of ER. So there will be a kind of demand for investment in that particular company. So those kind of securities are treated as underpriced securities, which will result in buy decisions by the analyst. Whereas when we see the expected return less than the required rate of return, it's a kind of a negative signal. The actual performance of the company based on its operation is much lesser than what the investor has linked to it corresponding to the risk of that company. So obviously, because of the negative signal, it is treated as overpriced, and typically a sell recommendation will be given by the analyst. So if there is a huge buy recommendation given, the price of it is going to go up, which means the expected rate of return slowly will become equal to the required rate of return. Similarly, here on the other side, if a sell recommendation is given, lot of selling will happen, which makes the price come down, which will result again in expected return will be converging to the required rate of return. So the buying and the selling process will continue until the expected rate of return is matching up with the required rate of return, and vice versa. So required rate of return is a very important concept as far as the valuation of the securities is concerned, or decisions or recommendations relating to the investment are concerned. Then other related concepts that we are supposed to look at as part of return is, one is a discount rate. Generally, we have used the discount rate in various contexts, even in our capital budgeting and various other scenarios. It is that particular rate of return